Why global financial markets are witnessing a wave of risk aversion. Global financial markets are currently grappling with heightened risk aversion, a trend that began to take shape late last week following disappointing economic data from the United States. This data reignited fears of a potential recession in the world's largest economy, leading to a significant shakeup across global markets. Asian markets closed on a particularly negative note, with Japan's Nikkei 225 index falling by 12.4% to end the day at 31,458 points. This marks the index's lowest closing level since December 2023, reflecting broader regional concerns about economic stability. European equity markets also experienced sharp declines at the start of the week. By 9:30 a.m. Central European Time on Monday, the Euro STOXX 50 index had dropped by 2.8%, reaching its lowest point since January and signaling its third consecutive day of losses. Among the major European indices, Italy's FTSE Mib emerged as the weakest performer, plummeting by 3.5% and on pace for its most significant single-day drop since March 2023. Meanwhile, Germany's DAX, France's CAC 40, and Spain's Ibex 35 all registered declines of approximately 2.5%. The banking sector was particularly hard hit. ING Group saw its shares plunge by 6.8%, while Société Générale fell by 5%. Other major banks also faced substantial declines. Deutsche Bank dropped by 4.4%, UniCredit by 4%, Intesa Sanpaolo by 3.9%, BNP Paribas by 3.9%, and Banco Santander by 3.5%. In the bond market, there was a noticeable shift towards safe haven assets as yields on the German yield curve declined. The two-year Bund yield fell by 6 basis points to 2.29%, marking its lowest level since March 2023. The 10-year Bund yield decreased by 3 basis points to 2.14%, reflecting increased investor demand for safer investments amidst the growing market uncertainty. Currently, market sentiment suggests that weak economic data is no longer seen as a sign of reduced risk, given that softer growth is driving yields lower rather than the disinflation narrative, noted Mohammed Al-Sarraf, FX and rates strategist at Danske Bank. The euro strengthened against the dollar, rising to 1.0950, its highest level since March 2024, largely due to the broad weakness of the US dollar. Meanwhile, the Japanese yen has enjoyed 5 consecutive days of appreciation against the dollar, following the unwinding of the carry trade that had previously driven the yen to multi-decade lows in July. On Monday, the USD-JPY exchange rate plummeted more than 2.4%, marking its worst performance since late 2022. What's happening with the US economy? Recent data from the US painted a troubling picture. Manufacturing activity contracted more than anticipated last month, and the jobs report revealed signs of a cooling labor market. The US economy added just 114,000 new non-farm payrolls in July, a sharp decline from the downwardly revised figure of 179,000 from the previous month and well below the expected 150,000 increase. Additionally, the unemployment rate unexpectedly climbed from 4.1% to 4.3%, reaching its highest level since October 2021. Quarterly earnings from major technology companies have been mixed, contributing to the S&P 500 index's third consecutive week of losses. Notably, Warren Buffett reduced his stake in Apple by nearly half, selling over $50 billion, $46 billion worth of shares, which has pushed Berkshire Hathaway's cash reserves to a record high of $277 billion, $254 billion. The combination of disappointing economic data and Wall Street's downturn has led investors to flock to safe haven assets, particularly US Treasury bonds, amid increasing speculation about potential Federal Reserve interest rate cuts. While acknowledging signs of economic weakening, they believe the US economy is not on the verge of collapse. Join our vibrant community and be in the know by subscribing to our channel for the latest news and captivating content.